All right, so you want to get smarter about investing, huh?
Sounds like it.
Well, you sent us a copy of Benjamin Graham's The Intelligent Investor. Smart move.
That's a classic.
Yeah, it's basically the Bible for, anyone who wants to build some real wealth without losing their shirt.
Yeah, without those rookie mistakes.
Exactly. And lucky for you, we're diving deep into it
We've
today.
got the inside scoop.
We do. So in this deep dive, our mission is to break down the most important ideas, the stuff that makes this book so influential, even today.
Timeless principles.
Exactly. And we'll help you figure out how to, actually use them in today's world.
Put those principles into practice.
Now, before we get into the nitty-gritty, let's talk about the man himself, Benjamin Graham.
The legend.
He wasn't just some, ivory tower academic.
Oh, no, not at all.
This guy ran his own investment partnership on Wall Street, dealt with real money, real risks.
Navigated the market's ups and downs.
Exactly. So he knew his stuff. And he was known for his, well, let's just say, meticulous research.
Obsessive, some might say.
Right. But that's what made him so successful. He was like a financial detective, uncovering those hidden clues
Yeah.
in those, dense financial reports.
The stuff that makes most people's eyes glaze over.
Yeah. And speaking of hidden clues, I've always been fascinated by those stories about investors who spot these undervalued companies, the ones the market seems to be totally missing.
The hidden gems.
Yeah. Was
Yeah.
Graham good at that?
Oh, he was a master. One great example is Northern Pipeline Company.
Northern Pipeline, okay.
Graham discovered their stock was trading way, way below the value of the bonds they held.
Seriously?
Yeah. Talk about a bargain. It's like finding a dollar bill on the ground, except that dollar bill could buy you an entire company. And he found this just by, digging through these obscure reports. Most people wouldn't have even known where to look.
That's wild. So he was basically like what, finding these treasure chests of value that everyone else was just walking past?
Exactly. And his book, The Intelligent Investor, is all about teaching you how to do the same thing, giving you the tools to analyze companies, understand their real worth, and then, make smart decisions, even when the market's going crazy.
Okay, that sounds promising, but the whole market going crazy thing, that kind of stresses me out. Is there a way to avoid getting, swept up in all that hype and the emotional roller coaster?
That's a great question, and it's something Graham addresses head on. He created this brilliant analogy called Mr. Market.
Mr. Market. Okay, I'm listening.
So picture this. Mr. Market shows up at your doorstep every single day.
Every day.
Yep. And he's offering to buy or sell you stocks. The catch. His mood swings wildly. One day he's euphoric, convinced the market's going to the moon, willing to pay ridiculous prices for your shares. The next day, he's in the dumps, panicking about a crash, wants to sell you his stocks for pennies.
Sounds exhausting. I wouldn't want that guy showing up at my door every day.
Right. But here's the point. Mr. Market, he's there to serve you, not to guide you. His emotional roller coaster. That's actually your opportunity.
My opportunity? How?
To buy low and sell high. If, and this is a big if you can keep your head when everyone else is losing theirs.
That's easier said than done. But I'm starting to get it. So intelligent investing is about, what, using Mr. Market's moods to our advantage, not letting him control our decisions.
Exactly. It's about staying rational, focusing on that long-term value, tuning out those short-term emotional outbursts.
Easier said than done, right?
Yeah.
Are there, specific things I can do to make sure I don't let Mr. Market get the best of me?
Absolutely. And that's where Graham's principles come in. He gives you a framework to make intelligent decisions even when the market's going haywire.
Okay, I'm all ears. Let's hear it. What are those key principles, according to Mr. Graham?
Well, first and foremost, thorough analysis.
Thorough analysis. So no more skimming headlines or listening to hot stock tips from my uncle.
Probably a good idea. It's about digging deep into a company's financial statements, understanding their business, their long-term prospects.
So it's more about being a financial detective than a gambler.
Exactly. You got to understand the true value of a business. Don't just speculate on those, potential price movements.
Got it.
Now, the second key principle is protection against losses.
Okay, protection. Safety first, right?
Exactly. Minimizing risk. He famously said, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Interesting. Safety of principle. He puts that first. Huh.
He does. It's about preserving your capital just as much as growing it.
I like that. Makes sense.
And this is where his concept of margin of safety comes in.
Margin of safety. Intriguing. Tell me more about that safety net.
It's basically buying a company for less than it's really worth, less than its intrinsic value. Think of it like getting a discount on a valuable item. If you
Right.
buy a dollar for 50 cents,
You're getting a deal.
you built in a cushion, room for error.
I like that. But how do you even figure out a company's, what was it, intrinsic value? That sounds complicated.
It does take some work, but Graham lays out several methods for doing it. You look at the company's assets, earnings, dividends, their overall financial health. You want a realistic picture of what a company's truly worth, not just what the market's pricing it at this very moment.
Okay, so looking beyond the hype in the stock prices, at the underlying business itself.
You got it. And that margin of safety, it's your protection against those inevitable market dips. And let's face it, even the best investors make mistakes sometimes.
That's true. Okay, so we've got thorough analysis.
Yeah.
We've got protection. What's the third leg of this intelligent investing stool?
Aiming for adequate, not extraordinary returns.
Adequate.
Graham wasn't about gambling or trying to hit it big on the next, hot stock. He believed in slow and steady.
So no get-rich-quick schemes here.
No. He argued that sticking to undervalued, well-managed companies, you can get solid, long-term returns without taking on crazy risk. And isn't that what most people really want from their investments?
Yeah, that makes sense.
Yeah.
But does it actually work? Yeah. Can someone be successful following these principles?
That's the best part. It's not just theory, it's a proven approach. He dedicated a whole chapter to what he calls the super investors of Graham and Doddsville. These are individuals who've consistently beat the market by following his principles.
Super investors. Sounds like a comic book.
Yeah.
Tell me more about these investing superheroes.
Well, the most famous is probably a name you've heard before, Warren Buffett.
Wait, the Warren Buffett, the Oracle of Omaha.
Yep. Buffett actually studied under Graham at Columbia Business School, and he credits Graham as one of his biggest influences. Think about Buffett's investment style. Patient, focused on value, long-term outlook, all hallmarks of Graham's approach.
That's incredible. Even the most successful investors rely on these, seemingly simple common sense principles.
It speaks to their power. They're not just for Wall Street gurus. They work for anyone.
That's encouraging. But the world of investing can be a little overwhelming, to be honest. Where does Graham suggest we even begin?
Well, he divides investors into two main categories, defensive and enterprising.
Okay, feeling a little defensive just thinking about all this. Tell me more about these two types.
The defensive investor, they want simplicity, safety. Think of it as the set it and forget it approach.
That does sound kind of nice, actually.
Right. They're not looking to spend hours analyzing companies or making trades every day. They just want to build a solid portfolio, something that'll grow steadily over time.
Okay, I can get behind that. What about the enterprising investor? Are those the ones poring over financial statements like Graham himself?
Those are the ones who are a bit more hands-on, willing to put in the work to potentially get higher returns. They aren't afraid to, roll up their sleeves, do the digging. They enjoy the challenge of finding those undervalued companies, making those calculated bets.
Okay, so two different paths, depending on what your goals and how much time you want to spend on it.
Exactly. He provides tailored guidance for each type, specific strategies, approaches, matching your risk tolerance and your style.
All right, well, let's start with those of us who are feeling a little more, shall we say, risk-averse. What kind of advice does Graham offer those defensive investors? How do they build a solid portfolio?
One of his favorite techniques is dollar cost averaging.
Dollar cost averaging. Is that like putting your spare change in a piggy bank?
Well, kinda. It's about investing a fixed amount of money regularly, no matter what the market's doing.
So like every week, no matter what?
Exactly. If the market dips, you're buying more shares at a lower price. If it's soaring, you're buying fewer shares at a higher price. It averages out your cost over time. You ride out those fluctuations.
Oh, so it takes the emotion out of it.
Exactly. It helps you avoid making, those impulsive decisions based on fear or greed. Over the long term, it's really effective.
I like that. I tend to panic when I see those red arrows on my investment apps. What else does he suggest for us defensive folks?
He's also big on diversification.
Diversification.
Investing 101, right. Don't put all your eggs in one basket.
So I shouldn't put all my money into one stock, even if it's promising the moon and back?
Probably not a good idea. He recommends a mix of stocks and bonds, spread out that risk. That way, if one investment goes down, the others can, cushion the blow.
Okay, makes sense. But what kind of stocks and bonds does he recommend? Are we talking about picking individual companies or
For stocks, he's a big fan of index funds.
index funds? Those are kind of like the all-in-one option, right?
That they are. Think of them as a basket of stocks. It tracks a specific market index, like the S&P 500. You're basically buying a tiny piece of hundreds of companies with just one investment.
Less research, more relaxation. Sounds good.
Right. It's low cost, diversified. You participate in the market's growth without picking individual winners and losers.
What about bonds?
For bonds, stick with high-quality U.S. government bonds. They're considered very safe. They might offer lower returns than stocks, but remember, for the defensive investor...
Safety first.
Exactly. It's all about balance, risk, and reward.
So for the defensive investor, it's about keeping it simple, minimizing risk, letting those investments grow steadily over time.
You got it. It's a strategy that anyone can use, no matter their experience level. But for those feeling a bit more adventurous, there's a whole other side to Graham's approach, geared towards those enterprising investors.
Okay, now that's where things get really interesting. What advice does he have for those of us who are ready to roll up our sleeves, put in the work?
Now that's where things get exciting. We're going to talk about that after the break. All right, so you want to be an enterprising investor?
Let's get enterprising.
Well, Graham actually dedicates a good chunk of the book to this,
Yeah.
guiding these investors and how to actually find those undervalued stocks.
Okay.
He gives you a whole framework for analyzing financials, assessing management, spotting those red flags.
Yeah. So it's all about finding those diamonds in the rough.
Exactly. He was a master at this, Gives you tons of examples of companies he analyzed and invested in successfully using this approach.
So like real-world examples, that's helpful.
Oh, yeah. One that comes to mind is Chrysler.
Chrysler, okay.
Back in the day, their stock price was, all over the place.
Up and down, up and down.
Yeah, it's a little roller coaster. But Graham, he saw through the noise.
He saw what the underlying value.
Exactly. Recognized the company was actually, significantly undervalued. And that's the key difference between an intelligent investor and a speculator.
Right.
The speculator gets caught up in the hype, the emotions of the market.
Okay.
But the intelligent investor, they do their homework, analyze the facts, make those decisions based on, the real worth of the company.
So what are some of the key things an enterprising investor should be looking for when they're, analyzing a company?
Well, he gives you a whole list. It's pretty comprehensive. But some of the most important factors, the company's financial statements, the quality of the management, and any red flags, any warning signs,
Okay, hold on. There's a lot to unpack there.
Yeah.
So let's start with the financial statements. What are we looking for in those?
All right, so you're going to be digging through those statements, and trust me, I know it can be daunting.
It can be a little intimidating.
Oh, yeah, but there are 3 key ratios that Graham wants you to focus on.
3 key ratios, okay.
These are like, the vital signs of a company's health.
Okay, I like that analogy. Give me those vital signs.
All right, first up, earnings per share, or EPS.
EPS, okay.
It's a measure of how much profit a company is making for each share of stock.
So more profit is good, right?
Generally, yes. You want to see that EPS is growing steadily over time.
Okay, consistency.
Yeah, that's a good sign. Indicates the company's on a solid trajectory.
All right, what's the next vital sign?
Next is the debt-to-equity ratio.
Debt to equity.
This tells you how much debt a company is using to finance its operations. A high debt-to-equity ratio, that can be a red flag.
Why is that?
Well, it means they're relying heavily on borrowed money.
Oh, okay.
Some debt can be healthy,
Right.
but too much, that puts a company at risk, especially during those economic downturns.
So it's like having too much credit card debt.
Exactly. You want a company with a reasonable amount of debt. Ideally, lower than average for their industry.
Debt in moderation. Got it. What's the third ratio?
Return on invested capital.
Yeah.
Or ROIC.
ROIC, all right.
This one's all about efficiency. It measures how well they're using their capital, their money, to actually generate profit.
Okay.
A high ROIC means the company's a lean, mean, profit-making machine.
We like those. So those are the 3 key ratios when you're, looking at those financials.
Yeah.
But you also mentioned that an enterprising investor should be checking out the management team, right?
Oh, yeah, absolutely.
But how do you even do that? You can't always just judge based on the numbers.
That's where it gets a little trickier. But Graham gives us some pointers.
Okay.
First, look at the company's track record. Have they been consistently profitable? Or have they been, all over the place?
So looking for the steady performers makes sense. What else?
Watch out for any signs of accounting manipulation.
Wait, companies actually do that?
Oh, sometimes. You got to be careful. They can use these, sneaky accounting tricks to make their performance look better than it really is.
That's not cool. Are there any, telltale signs to watch out for?
Definitely. Graham outlines a few red flags.
Give me those red flags.
Things like frequent special charges. Those mysterious non-recurring expenses that somehow keep recurring.
Right. Yeah.
Or changes in their accounting methods that suddenly make their earnings look inflated. Those can be signs that something fishy's going on.
So basically, making sure the company is being honest with its investors.
Exactly. Transparency is key. And another thing to watch out for is capital allocation.
Capital allocation.
Yeah, how the company uses its profits. Do they reinvest wisely, pay dividends to the shareholders?
Okay.
Or do they, blow it all on those acquisitions that never seem to work out?
So making sure management is making smart choices with the company's money.
Precisely. You can usually get a sense of this by looking at their history. Their mergers and acquisitions, dividend policy, their investments in research and development, things like that.
You're like giving us a secret decoder ring to understand these financial statements. This is great.
I try.
But beyond the numbers, beyond the management, are there any other, warning signs or traps that an enterprising investor should watch out for?
Oh, Graham was great at spotting those, a whole arsenal of red flags to watch out for. For example, he was particularly wary of IPOs. Initial public offerings.
IPOs. But aren't those the hot new stocks that everyone wants to get in on, the ones that are going to make you rich quick?
That's the hype. But Graham says, be careful. Historically, a lot of investors have gotten burned.
Really? So what's the problem with IPOs? Why was he so skeptical?
Well, for one thing, the valuations. They can be way inflated.
Especially for those companies that are, riding the wave of hype.
Exactly. The market's basically pricing in all this, future potential, even if the company hasn't actually proven itself yet.
So it's like potential versus reality.
Exactly. And that can lead to a disconnect between the company's actual performance and its stock price.
So you got to be realistic, make sure their current earnings justify that stock price, right?
That's Graham's philosophy. Focus on the present, not just the future. Another red flag. Companies with, flimsy business models.
Flimsy, what does that even mean?
Think of those companies that are built on buzzwords and hype, rather than actual solid products or services.
Okay.
There's a great example in the book, AAA Enterprises.
AAA?
Yeah. Went bankrupt just 2 years after their IPO. Their whole model was built on the buzzword franchising, but there was no substance behind it.
So buzzwords don't equal a good business.
Exactly. He really stresses understanding the economics of the business. What problem are they solving? How do they make money? What are their competitive advantages?
Right, right. Okay, so what other red flags are there?
Excessive debt. Remember that debt-to-equity ratio we talked about?
Yeah.
He uses Penn Central Railroad as an example. This was a company that seemed stable.
Seemingly stable.
Yeah, but ended up collapsing under a mountain of debt.
So even established companies can be risky.
Absolutely. Debt can make things worse, especially in tough times. And finally, watch out for those CEOs, the ones who are a little too ambitious.
Ones that are always expanding and,
Chasing the next shiny object, yeah.
So too much growth can be bad.
It can be, especially if it's fueled by debt or risky ventures. There's another example in the book, Ling Temco Vought Inc. They imploded, grew too fast, took on too much debt.
A classic case of growing pains.
Yeah, exactly. And it's a reminder that, sustainable growth is usually, it's gradual, well-managed, not explosive and reckless.
Okay, wow. A lot of potential traps out there.
There are, but that's why you read the book, right?
Right.
It gives you the roadmap to navigate those hazards, make those intelligent decisions.
You've convinced me. Graham's principles, they're timeless.
They are.
But how do we apply all this to today's market? I mean, it's a different world than when he was writing.
That's a great point. We've got so much innovation, disruption. Can these principles really apply to, companies like Tesla or Amazon?
Right. Those are all about rapid growth, cutting-edge technology. How did those old school principles hold up?
That's the fascinating part. They actually hold up really well.
Seriously?
Yeah. While some of those specific ratios and metrics that Graham used might need a little tweaking, to account for these new types of businesses.
Right.
The underlying principles, they're just as valid.
So it's about using the same framework, but maybe adjusting the lens a little bit?
Exactly. We still need to analyze those financials, assess the management, look for those bargains, just like Graham taught us. But we might need to look at, slightly different things when we're evaluating these companies.
Okay, I'm intrigued. What kind of things should we be looking at when we're evaluating, those innovative high-growth companies? How do we take Graham's approach and make it work for the 21st century?
Well, for one, we need to be willing to look beyond those, traditional measures of profitability.
Okay.
Instead of just earnings, look at things like their growth trajectory, their innovation pipeline, their market share.
So we're broadening our definition of what makes a good investment.
Exactly. Take Amazon, for example.
Amazon, okay.
They reinvested their profits for years, prioritizing growth over short-term earnings.
Which is, not the typical approach.
Not typical at all, but it paid off big time for their investors.
So it's about understanding the long-term potential, not getting hung up on those quarterly reports.
Exactly. Metrics like user growth, technological advancements. How are they disrupting these existing markets?
Wow, so Graham's approach is a lot more adaptable than I thought.
Oh, it is. It's all about understanding the essence of his principles.
Yeah.
The focus on value, the research, the discipline, and applying those thoughtfully to today's market, which, as you said, is exciting and changing rapidly.
This is fantastic. All right, so we've covered those core principles, the recommendations for both types of investors, and even how to adapt his approach for today's world.
We've been busy.
We have. But now I'm curious.
Yeah.
Are there specific investment vehicles or strategies that Graham recommends for, that enterprising investor?
Oh, absolutely. And it's amazing because even though he was writing decades ago, his recommendations are still relevant today. One approach he talks about is investing in net companies.
Net companies?
Yeah, these are companies whose stock is trading for less than the value of their net current assets.
Okay.
It's very conservative, focuses on the company's liquidation value.
Liquidation value, meaning like what they'd be worth if they just sold everything off, paid off their debts.
Exactly. Graham loved this approach because it provides a huge margin of safety. You're essentially buying the company's assets on sale.
Okay, yeah, I like that. But how do you even find these net companies?
It takes some digging for sure. You can't just, screen for certain price-to-earnings ratios or anything.
Right.
But he provides some criteria, Focus on companies with strong balance sheets, lots of liquidity.
So it's a strategy for the treasure hunters.
I like that.
All right, so what other strategies does Graham recommend for those enterprising investors?
He also talks about arbitrage opportunities.
Arbitrage.
Yeah.
That sounds a little intimidating.
It can be. It's essentially about, exploiting price differences between different markets or securities.
Okay.
So let's say, a company announces it's getting acquired by another company.
Right.
Often, the target company's stock will be trading at a discount to that acquisition price.
Okay.
An arbitrager, they'd buy that stock, betting that the price will eventually rise once the deal's done.
So it's about finding those inefficiencies in the market and profiting from them.
Exactly. It can be complex, but it can generate some nice returns if you know what you're doing.
Okay, so we've got the net companies, we've got arbitrage. Anything else?
He suggests looking for what he calls special situations.
Special situations, like what?
These are investment opportunities that arise from specific events.
Okay.
Like, let's say a company's restructuring, they're spinning off a division, or there's a legal settlement that's, going to bring in a bunch of cash.
Okay.
Those situations, they can create opportunities because they lead to changes in a company's valuation that the market might not have fully recognized yet.
So you got to be paying attention to those events.
Yeah, but they often require, some in-depth research to figure out the risks and the rewards.
Right, not for the casual observer.
Exactly. And then finally, he recommends exploring convertible bonds.
Convertible bonds. Remind me, what are those again?
They're bonds that can be converted into stock.
Cool. Right.
Of the issuing company. So it's kind of like a hybrid approach,
Best of both worlds.
You could say that. But Graham does say they can be complex.
Of course. Nothing's ever easy.
Right. You got to understand those conversion terms, evaluate the company's prospects.
Always do your homework.
Always.
So many options. How do you know which strategy is right for you? Which one aligns with your goals and your risk tolerance and all that?
That's a great question. It really gets to the heart of it all, Graham believed that, first and foremost, you got to understand yourself as an investor.
So self-awareness is key.
It is. Ask yourself, are you patient? Can you hold those investments for the long haul? Or are you more of a short-term trader? Do you have the time and the interest to dig into those statements, research those companies, And, how comfortable are you with those market swings?
Those are all really good questions.
Yeah.
And once you have an honest answer to those, then what?
Then you can start figuring out which strategies fit you. Maybe you love the net companies because you love the hunt, finding those deep value plays. Or maybe you're fascinated by arbitrage, analyzing those market inefficiencies.
So it's about finding the approach that, that speaks to you.
Exactly. And remember, there is no one right answer. What works for one person might not work for another.
Makes sense. Okay, so self-awareness, step one. What else?
He also says, you got to understand the market environment. Are we in a bull market, prices are rising, or are we in a bear market, prices are falling?
Right.
What are interest rates doing? What's the economic outlook? All those things can influence your strategy.
So you need to be adaptable.
You do. What works in one market might not work in another. And Graham actually gives some good advice on how to, assess all that, how to make informed decisions based on what you're seeing.
So his approach really is flexible.
It is.
Okay, we've talked about a lot the core principles, recommendations for both types of investors, how to adapt his approach. But now I'm curious. What would Graham think about, the role of technology in investing today? What would he think about all the online platforms, the robo-advisors, all the data and tools that we have now?
It's funny to think about,
It is. On the one hand, he was all about that meticulous research, digging into those financials. Imagine if he had access to all the stuff we have now.
Right.
But then again, he was also wary of speculation, getting caught up in the hype. And technology, it can make that even easier.
That's a really good point. It's a double-edged sword.
It is.
I think Graham would be, fascinated, but also a little cautious.
Okay, so how do you think he would view all those online platforms, the robo-advisors and all that?
Well, remember, one of his big principles was independent thinking.
Right.
He really believed that investors should, do their own research, make their own decisions. Don't just blindly follow the crowd.
Be in control of your own financial future.
Exactly. And I think in that sense, he'd see technology as a tool. It can either, help you or hurt you.
Depending on how you use it.
Exactly.
So it could be a weapon of mass financial destruction or a tool for empowerment.
I love that. It's so true. On the one hand, technology gives us access to so much. We can analyze companies in ways that Graham couldn't have even imagined. We've got real-time data, fancy charting tools, even AI that can, help us see patterns and trends.
Like having a superpower.
It is. But there's a catch.
There's always a catch.
Right. Technology also makes it easier to fall into those traps, the ones that Graham warned us about.
Like what? What kind of traps?
Well, it's easier than ever to get caught up in, the hype, the speculation. That drives those short-term market swings.
Right.
We're bombarded with news, opinions 24/7. Social media is full of, so-called gurus telling you what the next hot stock is going to be. All that noise can distract you from the, the fundamentals.
So it's like we have this amazing technology, but it makes it harder to stay focused.
You have a race car, but you've forgotten how to drive.
That's a great way to put it. And that's why I think Graham would say, use technology as a tool to support your own thinking, not to replace it.
So we still got to be in the driver's seat.
You do.
We need to understand the principles, do the research, make those decisions, even if we're using, fancy algorithms and robo-advisors.
Exactly.
Yeah.
Technology can help, but it can't replace that responsibility. We're intelligent investors.
Right. And that's a good reminder.
It is.
Okay, so we've covered so much.
We really have.
But before we go, what's one final takeaway from this whole deep dive?
Oh, that's tough. There are so many. But I think one of the most important things that Graham talked about was the psychology of investing.
The psychology?
Yeah. It's not just about the numbers, the analysis.
Okay.
It's about, your own mindset, your behavior.
Oh, interesting. So our own emotions can affect our decisions. Absolutely. Graham understood this. He saw how human emotions, things like, fear and greed, they can sabotage you.
Yeah. I mean, we've all been there, right? Panic selling when the market dips or chasing after that hot stock that everyone's talking about.
It's human nature. But Graham said, intelligent investors, they need to be aware of those emotions. They need strategies to stay calm, stay rational, even when things are, going crazy.
So it's about being like the master of your own mind.
That's it. And it's one of the hardest parts, but also the most rewarding.
I love that. And honestly, I think that's a great way to wrap up our exploration of his work.
It is.
He wasn't just teaching us about, balance sheets and ratios. He was teaching us how to be more thoughtful, more disciplined.
Better investors.
Exactly. This has been an amazing deep dive. We've learned so much from Graham's, his timeless wisdom.
I agree. Hopefully our listeners feel ready to start their own intelligent investing journeys.
Yeah, and remember, it doesn't have to be, complicated or intimidating.
Not at all.
By following